In this TaxSlayer Pro tutorial video, we'll discuss the 2016 tax law changes. As late as December, 2016 was shaping up to be a pretty uneventful year for federal tax law changes. Then, Congress passed the PATH Act, or Protecting Americans from Tax Hikes. When the PATH Act became law, a number of tax provisions that were set to expire suddenly became permanent. This made 2016 a year in which many Americans may find themselves eligible for some nice tax breaks. As far as tax season deadlines, the filing deadline to submit 2016 tax returns is Tuesday, April the 18th, 2017. The due date for tax extensions for 2016 returns is also April 18th, 2017. October 16th, 2017 is the last day to electronically file a 2016 federal tax return for tax extension filers. There are also some healthcare changes. Taxpayers without health insurance are going to face much higher IRS penalties on this year's tax return. The individual shared responsibility provision for not having qualifying health insurance rises greatly on 2016 tax returns. For 2016, the per-person penalty is $695 per adult and $347.50 per minor child, with the maximum household per-person penalty being $2,085. Health savings account contributions have also changed. The annual contribution limit for a family policy increases $100 this year to $6,750, with the additional $1,000 catch-up contribution also allowed for those who are 55 and older. The individual annual maximum out-of-pocket for co-payments on high-deductible health plans and deductibles rises this year. The increase is $100 for individuals up to $6,550 and $200 for families up to $13,100. Some cost of living adjustments on the 1040. The personal exemption rises $50 in 2016 to $4,050. The standard deduction for head of household filing status is up $50 from $9,250 to $9,300 on the 2016 tax return. Also for 2016, the alternative minimum tax exemption is $53,900 for a single filer and $83,800 for joint filers and heads of household. In 2015, these limits were $300 and $500 lower, respectively. The Earned Income Tax Credit, a very slight boost in 2016, $3 for the childless to a maximum of $506, $14 for families with one child to a maximum of $3,373, $24 for two-child families to a max of $5,572, and $27 for families having three or more qualifying children to a maximum credit of $62.69. The EITC has been made permanent for joint filers with three or more qualifying children. There's a phase-out range on Roth IRA contributions that's changed. The 2016 adjusted gross income phase-out range is $117,001 to $132,000 for single filers and heads of household, and $184,001 to $194,000 for joint filers. These ranges are $1,000 higher than they were in 2015. For those without a workplace retirement plan but with a spouse who's covered by a workplace retirement plan, the deduction phase-out range increases by $1,000 to $184,001 to $194,000. The income tax brackets. The tax brackets barely rose for 2016, only a 0.4% change above the 2015 levels. Some tax provisions have been made permanent. The $500,000 Section 179 deduction. In recent years, companies with gross receipts of less than $50 million a year have been able to take an immediate deduction of up to $500,000 for the cost of depreciable assets on purchases of up to $5 million. The PATH Act preserved the current limit, which was set to shrink back to old levels in 2015. A small business can continue to claim this deduction for software expenses and qualified leasehold, restaurant, and retail business expenses. The 15-year period for depreciating remodeling and other improvements made by a business has been made permanent. The old depreciation period was 39 years. At this point, there will be no going back to it. Some other tax provisions made permanent: the IRA charitable rollover. A traditional IRA owner who is at least 70.5 years old may make a charitable gift from that IRA to a qualified charity and also exclude the transferred amount from his or her gross income for the tax year in which the gift is made, and the gift must not be larger than $100,000. The option to deduct state and local sales taxes instead of state income taxes has been made permanent. If you live in a state that doesn't levy state income taxes, you may now continually take advantage of this provision. The enhanced child tax credit has been made permanent. Prior to 2009, the child tax credit was $1,000 per qualifying child. In that year, an additional or refundable tax credit equal to 15% of any earned income over $3,000 was offered to qualifying taxpayers. The enhanced child tax credit is made permanent under the PATH Act. The $2,500 American Opportunity Tax Credit has been made permanent. The AOTC used to offset higher education expenses was set at $2,500 in 2009. Beginning in 2017, it was scheduled to revert to its previous level of $1,800. Under the PATH Act, it remains at $2,500 with phase-outs starting at $80,000 for single filers and $160,000 for joint filers. The Enhanced Earned Income Tax Credit. In 2015, a low-income family with 3 or more children could receive an EITC of up to $62.42. As we mentioned earlier, PATH makes this enhancement to the EITC permanent. The deduction for educator expenses has also been made permanent. Classroom teachers in grades K through 12 may continue to take advantage of this above-the-line deduction on purchases of school supplies. It's now indexed for inflation, rising to $257 in 2016 from the previous $250. Canceled mortgage debt on a personal residence may still be forgiven. You can still exclude up to $2 million in qualified principal residence acquisition indebtedness resulting from a foreclosure, a short sale, or loan modification from your taxable income in 2016. Other tax provisions extended through 2016, mortgage insurance premiums may still be deducted, like mortgage interest. If you're required to make mortgage insurance payments to a lender, you have the opportunity to deduct those premiums for another year. In 2016, the adjusted gross income phase-out range for this deduction is $100,001 to $109,000. Other tax provisions extended through 2016, the tuition and fees deduction is still here. And this above-the-line deduction An above-the-line deduction requires no itemizing on the tax return, so keep that in mind. This applies to higher education costs and is capped at $4,000. You can qualify for this deduction merely by taking one single higher education course. Tax provisions extended through 2019. The 50% bonus depreciation. While 50% immediate expensing of asset acquisitions is still available in 2016 and 2017, bonus depreciation will be permitted at only 40% in 2018 and 30% in 2019 before disappearing altogether. Other changes to the Affordable Care Act include the Cadillac tax on high-cost employer-sponsored health plans has been pushed back for 2 years. This controversial tax will probably be amended or repealed. Businesses will not have to face it until the year 2020. Companies that sponsor health plans with a value greater than $27,500 for family coverage were going to be hit with an excise tax of 40% starting in 2018. Other changes to the Affordable Care Act: the 2.3% excise tax on medical devices has been suspended for 2016 and 2017. Another provision of the Affordable Care Act vanishes for the near future. Some other interesting developments in tax law changes for the tax year 2016. The IRS is cracking down on amended returns that claim the Earned Income Tax Credit and the Child Tax Credit. There's been a great deal of fraud in recent years by taxpayers who exploit these credits, and the IRS is responding. Specifically, the IRS has put new measures in place to make it tougher for non-citizens or taxpayers who were non-citizens in the relevant tax years to receive either one of these credits. Taxpayers may no longer file amended returns claiming the EITC for tax years in which they lacked a valid Social Security number. Also, taxpayers may not file amended returns claiming the Child Tax Credit for tax years in which they lacked a valid individual taxpayer identification number. Any taxpayer convicted of fraudulently claiming the EIC will be prevented from claiming that credit for 10 years. Thanks to the PATH Act, 529 plans have improved benefits. The IRS now allows 529 Education Savings Plan savers to pay for computer and technology expenses with 529 plan funds. Previously, 529 plan money could only be used to purchase computer hardware and software if the educational institution required the student to have that technology as a condition of enrollment. This is no more. Other interesting developments: if you owe $50,000 or more in back taxes, the federal government can revoke your passport. This isn't an internet rumor. The IRS can now contact the State Department and rescind passport privileges from taxpayers with federal tax debts of that size or greater. We want to thank you for watching this tutorial video, 2016 Tax Law Changes.